Today I was hoping to talk to you all about emerging markets, talk about volatility, right? Place that's been obviously not a positive place for a lot of investors, but one what we think long-term is a place to be. Now you could probably also tell that I was supposed to be joined by one of my colleagues talking about emerging market debt. But at the present time, you're just going to hear from, he decided to stay in Dallas instead, and probably has to head back to Pittsburgh. But I spent, I want to say, 8 hours on the tarmac yesterday and about 6 hours in the airport, so it was a lot of fun getting here, but I'm happy to be here. Last time I was here was probably about 20 years ago at Fort Bliss. I'm a tanker by trade in the military when I spent 30 plus years there, and working with the first ID in Germany was always a pretty exciting time. But I think Steve hit it on the head when he talked about the returns. So at the end of the day, today we're going to speak a little bit about emerging markets generally, some of the risks, some of the obviously opportunities, and most importantly, talk to you about what we think longer term the emerging markets might provide for investors and some of your investors, which is really, really important. You know, at the outset, Steve talked about returns, and I think, you know, we've done some calculations for the next 5 to 10 years. Emerging market equities are going to probably be the #1 returning asset class at close to 5%, followed by international small cap, then emerging market debt. Jason can't be here today to talk about that. And then obviously international. And some of the worst areas are going to be in obviously U.S. bonds, U.S. large cap, and U.S. smalls. And I'm sure you've heard that for a long time. But for us, we wanted to spend some time today talking about let's see, how does this work here? There we go. Talking about the emerging markets. Now, as we all know, you can see here that the U.S. still represents a quarter of the global GDP. Obviously, a very important factor. You know, if you think about post-World War II, it was closer to 50%. But if you were to take a time series of what it looked like with respect to the rest of the world, and the rest of the world would be Europe, it would be Japan, would be the developed markets, but you can see that the emerging markets now represent more than 1/3 of global GDP. And it's not just China, right? We'll talk a little bit about China later, but at the end of the day, we're talking about places like Brazil, population of 215 million. Indonesia, population of 275 million, and other parts of Southeast Asia. And then actually, if you look at the indices, MSCI, for example, you can see here, for example, that the U.S. still represents a very, very large proportion relative to its weight in the GDP world. Now, it doesn't mean that, obviously, market cap has a direct correlation, obviously, with global GDP, but it does highlight the fact that there's a big upside, particularly in the emerging markets space, as it relates to the ability to generate returns, obviously the innovation, demographics, and other factors that are going to be at play. So that's one thing I just want to start off. I've been traveling to the emerging markets. I think my first trip was to Morocco in 1983. My first trip to China was in 1987, so I've seen a lot of changes, and mostly positive. And actually, we're all starting to see innovation actually coming from some of these arenas. We'll talk about Kenya a little bit later. Now, these are some of the sector changes that we have seen in the emerging markets over the course of the last just 20 years. The first investment I ever made, I was backpacking in Indonesia, and I had my father-in-law invest in the Indonesian telecom company that was going basically going public. And I think for us, you can see here, just in 2000, you can see that historically, most of the emerging markets were dominated by materials, by financials, by regulated industries, and have over time, if you looked into 2020 here most recently, you can see a huge change in the way the benchmarks. So the benchmarks today are very, very different from where they were several years ago. And again, it's not just about China per se. It is a lot about Asia in general. But as you can see, information technology, who would have thought 20 years ago, I remember being in front of a pension in New Jersey, and they said, "Oh, you're never going to get the next Apple out of the emerging markets." Now, if you could call Taiwan Semiconductor or and basically Samsung Electronics, basically big players in their field, that innovation has come from the developing markets. And so technology and consumer discretionary are the two biggest changes. Financials have kind of stayed in the range, but again, at the end of the day, big changes. It's not what as a friend of mine always says, it's not your parents' emerging markets anymore. Things have changed quite dramatically. And so from a geographic perspective, the same thing has happened. So again, this is just in the last 20 years. You may all know that China joined the WTO in 2001, and that really became the accelerant, if you will, the catalyst for particularly Asia to move from what was then 40% in 2000 to close to 80% now. And in the interim, Latin America has lost some ground, Eastern Europe has lost some ground, but Middle East and Africa are actually still places that we see some great opportunity, as we do in Latin America as well. But it does highlight, again, the huge changes that have occurred in the emerging markets just in the last 20 years in our lifetimes, something to focus on. So it's not just about China as well, though. This is what I want to highlight. So this is emerging market GDP based on PPP, which is basically as a percentage of world GDP, ex-China. And what this shows you is that, in the 80s, it represented close to 25, 26%, 27%, and that now is close to 32%. So while China has been the biggest change within the emerging markets, it's not unusual or uncommon to also find that Taiwan, South Korea, Indonesia, Brazil, and others are now basically providing the weight to this growth. Again, a lot of this has to do with demographics. China is actually one of the few markets in the world where demographics are working against it. In China, for example, you had because of its one-child policy that was put into place under Deng Xiaoping in the 1970s, that basically China will have to grow rich before it grows old. And so they're much in a very different place, unlike, for example, India, which has over 60% of its population under the age of 30. So it's obviously growing quickly. It's a place that we find innovation. I can give you a quick story about one of our colleagues on our team who was from China, and he was planning on going back during we were talking about the real estate crisis, 2008, that obviously affected the international markets quite well at the time as well. And he was going to go back to China. He had 2 children at the time. It was going to cost him $150,000 per child to be able to go back. He now has 4. He's happily ensconced in the U.S., but obviously China has since released and got rid of its one-child policy. But it does highlight the fact that it's not just all about China. Now, when it comes to flows, again, this is mainly equity, but it's also partly debt. And you can see that over the years, it's kind of been in and out, very cyclical. And you can see within the last year to 2 years, it's been fairly negative. And so for those of you who have been looking at international, and it's been a tough place to be for the last 10 years, I just want to highlight the fact that we're getting closer and closer and closer, in my opinion, having been in these markets for a long time, very similar to the late 90s. The dollar was very strong. You had obviously the U.S. markets powerfully headed upward relative to the U.S. or relative to the rest of the world, and so it was a predominant proportion, obviously, of market cap. But that changed quickly in the next decade. And if you weren't invested in the emerging markets, you obviously didn't do so well. And so the dollar is a big key to this. Many of us have been wrong about the U.S. dollar's direction the last few years. I think first we had the tax cuts, then the tariff wars, then we had a few other reasons that the dollar remained stronger than it did, and then you had the pandemic, and then more recently, obviously, a more aggressive Fed with its policy mistake. But at the end of the day, risk right now is that the Fed continues to raise rates. I just came from Jackson Hole yesterday. Obviously, meetings going on there this week. And we're going to see how aggressive and serious the Fed is about, obviously, continuing to raise rates. We believe they will continue to raise rates at a higher level than the market currently expects, at least the market from the last few weeks. But this gives you an indication of the strength of the dollar. And obviously, there's an inverse relationship between emerging market currencies and returns and the U.S. dollar. And so with the U.S. dollar being very strong, really at levels that we have not seen really since the 2000s and previous to that in 1985. Obviously, it's not just emerging market currencies, right? It's also basically the euro. My sister from Europe, was just visiting us here recently, and very expensive for her relative to normal. We had our CIO was in Ireland and Scotland last week, and he was, was basically marveling at how cheap London was. Now, London's never cheap, but obviously with the dollar strength right now, it does highlight the fact that we're in one of those ranges, 1985, 86, or basically 2000, where we expect the dollar at some point in time to come back down with obviously relative to not just the euro and the yen, but also emerging markets in general. Now, I'm not here to talk about emerging market debt, but I will touch on a few major things. So emerging market corporate assets do offer very good value. It's not my bailiwick or my area of expertise. Again, Jason couldn't be with us today, but at the end of the day, this market has changed dramatically over the course of the last 20 years. It's much more deep. It is much more open. It's not just sovereign, it's also corporate. So the corporate players are coming to the market internationally, globally, to gain access to capital, and therefore providing some of the innovation we'll talk about a little bit later. Innovation, whether it comes in the form of semiconductors, innovation if it comes in the form of social media and technology, innovation as it comes to, for example, EVs, electric vehicles, and the future of that. But at the end of the day, you can see that more than 25% of the global bond universe is now emerging markets as well. So that's growing quite dramatically relative to just where it was a few years ago. Now let's talk a little bit about some macro factors out there. We have obviously, you can see at the end of the day, this would be the pandemic, and then you had massive global liquidity injections as well as fiscal pump priming around the world. What's interesting, again, most of that did not occur this time in the emerging markets. So if you think back to 2008, and we don't go back that far on this slide, I apologize, this is the Global Purchasing Managers Index, PMIs around the world, but China put to work basically $1 trillion shovel-ready work in 2009, which then obviously gave a boost to emerging markets assets. And this time, China's actually been sitting on the sidelines while the rest of the world has been providing more of the stimulus. But you can see that we've had this nice rebound, and now we're dealing with some of the after effects, not just of the pandemic, but also, if you will, the hangover effects of what has occurred with respect to central bank liquidity, which is too high, as well as some of the fiscal pump priming that has occurred, not just in the U.S., but also in Europe. And you can see that we're definitely heading towards what I would refer to as a mild global recession. The firm view is that we're going to have a rocky landing, but it highlights the fact that both supply chain issues as well as these inflationary pressures that are out there are coming to roost. That will be something, again, on the one hand, we are starting to see some of the companies dealing with much better supply chain issues, for example, on the chip side in the automobile sector, our discussions with some of the European players, but also it still remains an issue for most players in the industrial space. So, just because global GDP growth is going to obviously weaken doesn't mean that assets won't. And a perfect example of this is Brazil, a market that we've been invested in. Now, there's a little bit of a risk there because, as you know, they have elections coming up later this year. And elections means usually volatility, particularly in some of these emerging markets. It'll be very interesting because you've got not just very much like the U.S., a very left-right candidate right in Bolsonaro, left in Lula, so we'll see where that goes. But at the end of the day, assets can outperform just because global GDP is contracting. And you can see here on the right-hand side how dramatically the S&P has vastly outperformed relative to what it should have. Now, again, this reminds me, really, it's not all that dissimilar from the late 1990s, early 2000s, when it looked very similar. When we had the NASDAQ bubble, we had a very strong dollar. We had a situation in which the U.S. could do no wrong, and then you obviously, again, had a decade in which international and emerging markets outperformed, and we think we're fairly close to that. In terms of the other areas, I think is very interesting. If you think back in history, emerging markets were always considered the weak link of the global economy. And we think things have actually changed in the last decade to the point where it's actually the developed markets that are the weakest link. And it's not so much the U.S. We can talk a little bit about Europe as well if you'd like during the question and answer session. But you can see here, just on this chart alone, that in the last few years, central government debt, which used to be a huge issue primarily in the Latin American countries, but even across the board in emerging markets, something that is, and in green you can see these are emerging markets, generally speaking, and in blue these are developed markets. You can see that debt is increased dramatically the last 15, 20 years. Part of that has to do with obviously 2008, and then partly has to do with the post-pandemic spending. But it highlights the fact that that the changes are afoot from the debt perspective. And one thing I'd like you to really highlight is all of these countries, save maybe Canada and to some degree United States, are countries that are not growing demographically. So Italy, obviously Japan, France, these are countries and markets that are growing old quickly. Japan has the oldest society in the world. And so they're, again, a race against time, so to speak, in this debt-fueled kind of central government scenario. Whereas most of the rest of the emerging markets have done a much, much better job at handling the debt. A lot of it has to do with commodities, and we'll talk about that in a minute as well. But it's something that is an important factor when looking at assets abroad. So we talked a little bit about commodity prices. This is obviously, commodity prices are a two-edged sword. And I say that because if you think just about the BRICS themselves, okay, when Jim O'Neill coined the BRICS phrase about 22 years ago, you've got obviously Brazil, Russia, India, China, and South Africa. Well, two of those nations, that would be India and China, are commodity buyers. And the rest of those, Brazil, Russia, which is no longer really a factor, if you will, in the international investment markets right now, but then South Africa, are commodity players. And so that really is representative of all the emerging markets. There is a selectivity bias for those markets that are commodity producers versus those markets that are commodity buyers. And so the Indonesias of the world, lots of mining, Brazil's, obviously sugarcane, iron ore, oil, they're going to be the biggest beneficiaries of this current scenario. And we use a top-down country allocation approach in how we look at the world, and it's really focused on four factors: valuation, risk, growth, momentum. But the best way to look at it is this model forces us to look at those markets that have the lowest valuations or the most compelling valuations relative and the least amount of risk. And by risk, we're basically looking at current account to GDP and then real effective exchange rates. So what we're trying to find are markets that have a current account surpluses, not basically deficits, because those are the ones that are going to be obviously much more competitive, and then ones that have a currency that are weaker as opposed to stronger. And so our top-down is definitely focusing our attention more and more and more on the Middle East, on the Indonesias of the world, on the Malaysias of the world. Malaysia is a big oil producer, and those types of markets, whereas other markets that are potentially commodity, obviously buyers, are at a disadvantage in the current. We'll see where that goes. Obviously, a lot of this has to do with capacity as well as global economic growth. So if global economic growth does slow as we expect, we do expect some pressures as it relates to how it affects the commodity prices around the world. And another big factor, we can touch on that later, either questions and answers, or I can touch on, is the fact that the Chinese property market is under major stress and pressure right now. And infrastructure spend, while it is occurring, is nowhere near where it was several years ago. Let's talk a little bit about inflation. Obviously, we talked a little bit about the commodities, but commodity players benefit, obviously, from higher. So as commodity prices go up, the Indonesias, the Brazils of the world, South Africans do very well. The biggest issue we are seeing, and the one place we're not seeing any inflation right now, is China. That's partly because they have a big reliance, their CPI has a big reliance on pork prices. And pork prices are in a kind of a downward spiral because they had an issue with bird flu a few years ago. Then they ramped up the herds, and now they have an overcapacity of pork. But generally speaking, inflation is something that's affecting most emerging markets across the board. And obviously, with the U.S. central bank raising rates, with the dollar strong, that is a big negative for emerging markets assets. But again, if you look at the return on that longer term, you're going to have a reversal. And that's where we expect emerging markets to do well. And as you all know, emerging markets are no stranger to inflation. We've seen in years past, Latin America in particular dealing with some of its economic policies, inflation being very, very high. I think the poster child right now, some of the weak links in the world will be Turkey. As you know, Turkey is using a very unconventional central bank policy, monetary policy. They're actually cutting rates, and I wish I had a slide of the Turkish lira, but it is on a massive downward slope. I think right now inflation in Turkey is about 100% a month. So it's not out of control yet, but it's something that does affect some of these weak links around the world. Again, generally speaking, when there's a central bank tightening cycle, when the Fed is raising rates like we're seeing now, and again, our expectation is they're going to go longer, they're going to go higher for longer, that there are going to be weak links in the emerging markets. You've already seen Sri Lanka, Peru, a few other places around the world. They're going to be affected socially by some of the factors globally playing in the world. All right, so again, this is more of a slide relevant to EM debt, but at the end of the day, I think we kind of talked about this already. Depending on which market you're in, those that are commodity producers are currently big beneficiaries. For example, we have a exposure to a company called Airtel Africa. It's a huge player in Nigeria. Africa is a fast-growing, very demographic, young population and growing very quickly. And so Nigeria, which is a big oil exporter, is one of the big beneficiaries. And on the other hand, China, which much like India has to import fuel, has to import commodities, is at a disadvantage in this type of thing. And so that's where the selectivity question all comes to play. Now, deglobalization is also a factor out there. Our view is that we've had now a 20, 30, 40, 50-year cycle of globalization. We've had outsourcing. You've had a scenario in which companies here in the U.S., companies in Europe are looking to find cheaper places to produce. We've been finding for the last several years the companies we're talking to are reshoring to a much greater degree than we ever had. And so Mexico is a perfect example of this. Obviously, on the one hand, Mexico is in some ways a loser relative to the U.S., but in relative to Asia, it's a big, big winner. Because you're going to see more and more. We have a company invested in Japan, Nidec. They make small motors that go into everything from vacuum cleaners to electric vehicles. They have production sites all over the world. They are starting to produce more and more in Mexico and the U.S. and less so in Asia because they want to be closer to their clients. They want to be close. They don't want to deal with the supply chain issues that we've been dealing with for the last few years. So that's something that's very, very important. Again, Latin America is probably the biggest winner, particularly as the U.S. reshores some of these things. Just within the semiconductor space alone, our team is out of Ohio. We just celebrated our 25th anniversary, and we had basically Intel, as you may know, announced a big plant that's coming to Columbus. But that's one of the many, several in Texas, several in Arizona, that where we're going to start to see production actually being reshoring to the U.S., something we haven't seen for quite some time. Part of that has to do with what's going on with geopolitics within, obviously, during the Trump administration, the tariff wars, and some of the other factors that led to that. But the pandemic has also sent shockwaves through the supply chain that are allowing and helping some of these companies now to reconsider some of where they're actually producing. So let's look a little bit at earnings estimates around the world, and what you can see here in the blue line is the S&P, the highest there. So obviously the U.S. markets have been on fire. EPS estimates have been very, very strong. Emerging markets have kind of been hanging in there. They're not that much lower, but then obviously it's been basically IFA and Asia where you've had some weakness. And for us, again, everything is cyclical. We expect that at the end of the day that the U.S. market will not obviously collapse per se, but relatively speaking, it's going to be an underperformer relative to some of the other markets. And EPS, obviously, estimates are one factor in that orientation. Let's look at the EM index. Again, this is what I do on a day in, day out basis. We have an ACWI fund. We also have, obviously, an EM fund. I've been investing in the emerging markets now for 20 years. But you can see over the course of the last 20 years how we've had these overvaluations. Again, this is basically during the global financial crisis. Two things happened. One is, obviously, you had the Fed work its magic, but you also had the Chinese government put into play a huge stimulus package that helped, and then this is the kind of the rebound from that era. This was the kind of the global synchronized upturn of 2005 to 2008. Then you had the global financial crisis, and then you had this rebound, particularly in the emerging markets, based on some of that fiscal stimulus, primarily produced and provided by China at the time, but really by many of them. And you can see for at least the last 10 years that while they've had slight bumps, if you will, relative performance to the rest of the world, emerging markets have been underperformers. And again, you can't look at the emerging markets as a whole. Again, they're all very different. We talked about the differences between commodity price. We talked the difference about demographics. But generally speaking, right now we are at the lows relative to where we've been for many, many years. And as you may recall, again, from 2000 to 2008, 9, 10, kind of the glory years of emerging markets, we probably won't see the massive moves we did in commodity and Chinese prices that we did then, but we will see a very similar relative outperformance relative to the U.S. So let's talk a little about China, because China is a market that is now number 2 in the world. Literally a year and a half ago, China represented close to 45% of the emerging markets index. That's no longer the case. It's back down to the low 30s. But China is obviously the big gorilla, if you will, within the emerging market context. There's geopolitical consideration, other factors to consider. I've been going there since 1987. We've got a team member on our team who grew up there, worked for IBM in China, and understands the market and understands the actual ministerial and government background. So the economy is slowly recovering. And if you think about COVID, they were first in, first out, but then they've pursued this zero tolerance strategy on COVID, and that has probably not helped. You could argue, if a conspiracy theory, what the purpose is, but my guess is it's for Xi Jinping to save face. As you may know, they have their basically every 5 years, their annual Congress this year, where he will be reelected, if that's the right word to put it. But something, is definitely, I think the miscalculation on the negative effects that this COVID policy would have was something that they hadn't considered. Now, again, I talked about inflation a little bit because pork prices and some other factors have not been as big of a factor within China. Inflation is not that big of a deal. Now, the good news is, and obviously from the perspective of Chinese policy, whether it's common prosperity or whether it's regulatory oversight or any other factor. The good news is that China does have a lot of policy flexibility. So they've already had 2 cuts. So I mentioned earlier how when the US Fed, when the ECB, when the BOJ, when the Bank of England, when the Swiss National Bank were all cutting rates and providing lots of liquidity to the markets, the Bank of China did nothing this time. And so they have a lot more firepower, if you will, and are able to do that. Same on the fiscal policy front. Unlike 2008, when China spent $1 trillion within a month, that's not now occurring. And so you have a much higher potential for, and you're starting to see on the property front. So property is one area I want to talk about a little bit, because property, it's the last major risk kind of characteristic there at the bottom. So the Chinese property market is important because historically it was the store of wealth for most Chinese people, and still is. Whereas the stock markets have obviously become more well-funded, and they're much more advanced and complex than they were 20 or 30 years ago. Housing is really the way in which the average Chinese has not just become wealthy, but has grown their wealth assets over time. And the reason this has worked very well is you've had this move from the basically the rural areas to the urban areas. So you have this massive urbanization. So just to give you some highlights, in 1990, China was 19% urbanized. We're at about 60% urbanized. Just last year, China is over 55% urbanized, which tells you that in really in less than a generation, when you've had so many people move to the cities, again, housing was the way to do this. The provincial governments, they would then sell real estate. Obviously, they're very tight with the developers. Developers are overextended right now. And so there's a regulatory risk still on the housing front, and this is where the government has generally helped when they want to and be supportive. So we'll see how that plays out. So on some of these other negatives, obviously with a zero COVID tolerance policy, you have very low consumer confidence right now, even in automobile purchases, whether you're in housing. It doesn't matter. You also have very high unemployment. So there's a lot of uncertainty in the Chinese markets right now. For example, I think it's at 19% unemployment rate for the youth under 25. So that is not a good sign, obviously, for Xi Jinping. We'll see what he does with that. But it's something that we need to keep on our radar screen. The other big thing, obviously, with what's happening with Ukraine and Europe is that exports are still very strong for China. So they are still exporting massively to the rest of the world. Again, historically, this was the globalization wave. This was the way that disinflation, deflation really reared its ugly head, because it was cheaper for those to manufacture in China and then ship to the rest of the world. So right now, obviously, the global economy is kind of in a slow mode arena. Particularly Europe is not doing so well. U.S. is still okay, but it does mean that the export strength that historically supported the Chinese market is definitely basically on the fritz right now. So let's talk about some of just the final thoughts, and before I go into taking some questions. And again, I apologize that Jason couldn't be here to talk a little more in depth about the emerging debt arena. Would have been a great interaction, but the long-term stories of emerging markets have not changed. And that is that you've got demographic, economic, and policy support that's there. Again, it depends on where you look. You have to be selective. You can't, it's not a one-size-fits-all. One thing I'd like to also touch on a little bit is transformation and innovation. So for example, we're no longer invested in the company, but in Kenya, you don't think of Kenya as a place where there's a lot of innovation. Well, 10 years ago, they actually came up with an app whereby the average Kenyan, subsistence farmers or small businessmen could literally, for the first time ever, have not only a phone, but also a bank account via their phone, and then able to pay through mobile apps You go to a market in Kenya nowadays, and you can literally, every person is using their phone to transact business, something you would never have considered just 15, 20 years ago. Electric vehicles. South Korea is on the forefront of producing some of the best technology for batteries, for separators, and for other areas. China is not far behind, and China is making a very, very big push in the electric vehicle front. Not a surprise, right? Most of Asia, Japan, South Korea, China included, are not resource rich. They have to buy these resources abroad. And so they put a lot of money into technology to try to find some of these hidden gems, so to speak. Biotechnology is another area where we're finding some really unique companies. Again, 20 or 30 years ago, I never in my mind would have thought I would find some of these top-notch biotechnology, electric vehicle companies, or communication services companies outside of Europe, the US, and Japan, but we're starting to see that the last few years. Now, we haven't talked much about, we can touch on it later, but obviously the Ukraine conflict is something that is affecting the global environment entirely. It's not just fertilizer prices, it's oil, but it's something that is an inflationary, if you will, accelerant. So it's something that has exacerbated the supply chain, something that we continue to watch closely. So we talked about some of these other tailwinds. We talked about capital flows. Again, they've been negative. We think they're going to turn around. We'll see. Valuations are definitely, I mentioned earlier, if you were looking at the next 5 to 10 years, emerging markets are probably the #1 return asset class that we can find relative to anything else. Now, again, this has a lot to do with where the dollar goes, right? So the dollar is in a place right now that has been super extended. It's done this several times in the course of my career since the mid to late 80s. Again, we expect, timing is always difficult, and you could argue that when we started to weaponize the US dollar, and I can tell you from my contacts in the emerging market world, when we started to use the dollar against Russian billionaires and oligarchs, that everyone else around the world took note. Whether you're a Brunei billionaire or someone else, you're probably not going to park your money in US dollars exclusively anymore, even in Swiss bank accounts, because the Swiss also weaponized, obviously, their financial system. And so the dollar is definitely in a place right now. I don't think the dollar will be displaced. We can talk about that if there are any questions in the near term, because there's so many different factors at play, but we're definitely in a place now where it's more of a multi-currency scenario. We talked about all of that. All right, so final point is selectivity remains key. You can't just invest. I want to say, if you had invested in the EEM ETF in 2001, you could have gone and played golf for the next 10 years because it was up 14%. The S&P was up 4% annualized for the next decade. But those days are over. You have to be much more selective because of the way these emerging markets have now changed. Hopefully I've provided that, whether it's from the perspective of sectoral biases and changes or geographic ones, but very, very different long term.